Hello future chartered accountant. Today is day 4th and we'll start with question number 5th. So come to question number 5th. The question is of May 2016 attempt. Similar question asked in May 2019 and is also given RTP 2018. So following is a summarized balance sheet of Complicated Limited as on 31st of March 2016. Equity shares of rupees 10 each fully paid up. So equity share is of rupees how much? Of rupees 10 each fully paid up, which is 12,50,000. Now after that bonus share. So remember bonus shares is also equity share capital. Is also equity share capital, which is given separately here. But a bonus share is the share which we have given at free of cost. Which we have given at free of cost. Bonus, additional share that we have given to existing shareholder at free of cost. This is also equity share capital. So your total equity share capital will be 12,50,000 plus 1 lakh. That will be how much? 13,50,000. So total paid up capital will be 13,50,000. Now after this, share option outstanding account. Sometime company offers shares to their employees. Sometime company offer shares to their employee and at a price which is lower than the market price. At a lower than the market price. So at that time, why they offer at a lower than the market price? They put some condition on employee. For example, you have to stay with the company for the next 3 years or 5 years. Then we'll give you share of the company which is lower than the market price. Suppose the market price is rupees, suppose 500. We'll give them at rupees 200 rupees. Example. So we offer them at a lower price. So at that time, we call it is employee stock option plan. So at that time, we create a reserve. At that time, we create a reserve and this reserve will be converted into share capital only. This reserve will be converted into share capital. So this share option outstanding account, it's a new term for you. It will come under reserve and surplus. It will come under reserve and surplus. But remember, it is a part of basically ESOP chapter. But share option outstanding account, it's come under reserve and surplus. But remember one thing, it is not a free reserve. It is not a free reserve. It is not a free reserve. Which we recorded under share option outstanding, we recorded under reserve and surplus because ultimately it will be converted into share capital. At the time we will give shares to employees. At that time it will be converted into share capital. So we recorded under reserve and surplus as per Schedule 3 of the Companies Act, but it is not a free reserve. Now second is revenue reserve, which is free reserve. Revenue reserve is a free reserve. So revenue reserve is a free reserve. Then securities premium is not a free reserve, but when we do the calculation of buyback, at that time, we also consider securities premium. So this is also a free reserve only for the purpose of buyback and sale. Profit and loss account balance, it is also free reserve. Then capital reserve, you have here 1 lakh, revaluation reserve 1 lakh, unpaid dividend 1 lakh. Unpaid dividend is liability. These three are free reserve. Free reserve. I know that securities premium is not free reserve, but for the purpose of buyback, as per the Companies Act, we also consider it as free reserve. Now I'm coming to next one. Next point here, the unpaid dividend. Unpaid dividend is liability. It's a debt. Unpaid dividend means we are liable to pay. It is a dividend payable, but we have not paid it. It's a debt. It's a debt. Okay. Then it will come under current liability. Okay. 12% debenture secured, 12% debenture, it is also debt. It will come under long-term borrowing. Okay. Then advance from related party. You have taken a advance from related party. It is also a liability for you. It's a debt. Then current maturity of long-term borrowing. What do you mean by current maturity of long-term borrowing? Suppose you have taken a loan of rupees 10 lakh and from the date of balance sheet, 1 lakh is payable within a year. From the date of balance sheet, I am saying 1 lakh is payable within the year and remaining 9 lakh is payable after 1 year. I mean to say, you have taken a loan of rupees, suppose 10 lakh. This balance sheet date, suppose 31st of March 23, suppose balance sheet date. So here for the amount which is payable in 1 year, suppose here 1 lakh rupees I am liable to pay and in the next 9 years I am liable to pay 9 lakh. So this is current maturity of long-term borrowing. This is current maturity of long-term borrowing. We call it current maturity of long-term borrowing. Okay. So it is also a liability bit. Then application money received for allotment due for refund. So you have received the application money, but received for allotment due for refund. Due for refund means application money, you have received the application money, the excess application money that we are liable to refund, repay, refund. If you are liable to refund, then it is a liability for us. We are liable to pay. So all these points are related to debt. So here now they given us fixed asset 46,50,000, current asset 40 lakhs. The company wants to buy back 25,000 equity shares of rupees 10 each on 1st of April 2016 at rupees 20 per share. What is the face value of share? Face value of share is rupees 10 each on 1st of April 2016, and they want to do buyback at what price? They want to do buyback at rupees 20. It means rupees 10 is premium on buyback. We are doing the buyback of rupees 10. We are doing buyback at rupees 20. So difference of rupees 10 represent the excess amount that we are paying here. Represent what? It represents the premium on buyback. Buyback of share is duly authorized by article and necessary resolution has been passed by the company toward this. The payment for buyback of share will be made by the company out of sufficient bank balance available shown as part of current asset. What does it mean? It is mentioned that they will pay the buyback amount out of the sufficient cash balance they have as a part of current asset. It means bank, when they will pay it, that is a bank account. And bank is a part of what? Bank balance is a part of current asset. That's why they are saying out of sufficient bank balance available show as a part of current asset. It is a part of this current asset. They have not mentioned inventory and different inventory, bank balance, cash, trade receivable. They have not mentioned it. They have mentioned current asset. So all these come under current asset. Okay. So now they tell us that comment with your calculation. Now this is very dangerous. What does it mean? Comment with your calculation. It means that we have to calculate those three tests. You remember those three tests? What are those three tests? That is, we have to calculate here that debt equity. Just one. First is where it is resource test, then share outstanding test, and debt equity ratio test. So we have to do calculation. We have to, because it is asked in the question, comment with your calculation whether the buyback of shares by the company is within the provision of the Companies Act 2013. If yes, pass necessary journal entries towards buyback of share and prepare the balance sheet after the buyback of shares. So we have to first do the calculation and maximum number of shares that they can do buyback as per the provision of the Companies Act. We have to first calculate it, and we have to see whether this 25,000 is within that limit. If yes, then we have to pass journal entry. Then after buyback, then we have to prepare what? Balance sheet. So first write down here. Okay, write down here day 4 and question number 5, page number 11. So question number 5, page number 11. Question number 5, page number 11. So first we'll do the calculation. So write down here determination of buyback of maximum number of shares as per Companies Act 2013. As per Companies Act 2013. So first is the resource test. Okay. So write down here. First is resource test. So here the condition is maximum permitted limit is 25% of paid up capital and free reserve of paid up capital and free reserve. So here what happened? First we have to calculate paid up capital and free reserve. As you can see in question, there are so many free reserve here and so many debt here. So what we can do, we know paid up capital is 13,50,000. But what we can do here, we can calculate here that free reserve also. We can make a working note on paid up capital and free reserve. We can also make a working note on debt because the items are more here. So we can make a working note on it. So what you have to do, you have to keep the space for 1.5 page. Keep the space for 1.5 page. Okay. Keep the space for 1.5 page and then write down. Working note. Keep the space for 1.5 page and then write down working note. Okay. So working note number 1. Working note number 1. Paid up capital and paid up capital and free reserve. Paid up capital and free reserve. Okay. So we'll do the calculation of paid up capital and free reserve. First write down here equity share capital which is given in question. Equity share capital including, write down, including bonus shares. Including bonus shares. How much is the equity share capital which is given? Which is 12,50,000. 12,50,000. Equity share capital is 12,50,000 which is given in question. Plus 1 lakh as bonus shares. The total paid up capital is 13,50,000. Then add free reserve. Whenever I say free reserve for buyback, that is including securities premium. So free reserves, write down here including securities premium. Including securities premium account. Okay. So here, first free reserve which is given here, revenue reserve, which is given in question. Revenue reserve is how much? Revenue reserve is 15 lakh. So revenue reserve 15 lakhs. Then you have securities premium. Then you have securities premium. Securities premium. Securities premium is 2,50,000. Okay, then you have profit and loss account is 1,25,000. So profit and loss account balance 1,25,000. So do the total of free reserve including securities premium. That is 15 lakhs plus 2,50,000 plus 1,25,000. That is 18,75,000. So total paid up capital and free reserve 13,50,000 plus 18,75,000. That's come 32,25,000. 32,25,000. Okay. Now we can write down here working note on depth also. Depth. Okay. So first debt, these are the debt 4-5 items. Unpaid dividend. How much? 1 lakh. So unpaid dividend. Unpaid dividend 1 lakh. Then you have 12% debenture 18,75,000. 18,75,000. So 12% debentures, write down in brackets secured. Okay. Then you have advance from related party. You have taken advance from a related parties. Unsecured loan it is. Yeah, unsecured advance it is 10 lakh. So advance from related parties. Unsecured 10 lakhs. 10 lakh. Then current maturity of long-term borrowing 16,50,000. Current maturity of long-term borrowing. Current maturity of long-term borrowing long term borrowing. How much it is? 16,50,000. 16,50,000. Then at the end, your application money received for allotment due for refund is 2 lakh. So application money received for allotment due for refund. For allotment due for refund, it is 2 lakh. How much? 2 lakh. So total here 1 lakh plus 18 lakh 75,000 plus 10 lakh plus 16 lakh 50,000 plus 2 lakh. That is 48 lakh. 48 lakh 25,000 total amount of debt. Okay. Okay, all of you written. Now come there. First test, that is resource test. So write down here resource test. Okay, write down here paid up capital and free reserves. We have calculated it working note number 1. That is, see in working note number 1 how much it is? 32 lakh 25,000. So write down here 32 lakh 25,000. Then condition 25% we can utilize. So 25% of paid up capital and free reserve, 25% of rupees 32 lakh 25,000. That's come 32 lakh 25,000 multiplied by 25%. That's come 8 lakh 6,250. So how much amount we can utilize for the purpose of buyback as per first condition? 8 lakh 6,250. But if you want to convert it to number of shares, for one share, how much we are paying? For one share, we are paying 20 rupees. So write down here maximum number of shares that can be bought back is rupees 8,06,250 divided by rupees 20. So how much you are paying for one share? Rupees 20. If I have 8,06,250 and for one share I am paying rupees 20, so divided by 20. So how much it is? It is coming 40,312.5. So how much we will consider? 40,300, not 12. If it is 12.5, don't tell me 313 will consider. No, it will consider only 12 only. So 40,312 shares. We have discussed about it. If you say 0.5, we round it off to 313. So 40,313 multiplied by 20 if you do, that's come 8,06,260. It is more than the amount which is permitted. So don't round it off to 313. Take it as 312 only. Okay. Now, as per first condition, how much maximum share that we can do buyback? 40,312. Now, second test here, share outstanding test. Share outstanding test. Okay. So second test. Now, number of shares. Outstanding. First, we have to calculate the number of shares outstanding. So total amount of share capital is 12,50,000 plus 1 lakh is of bonus shares. And one share is of rupees how much? One share is of rupees 10. So divided by 10, one share is of rupees 10. So 13,50,000 divided by 10. So total number of shares outstanding 1,35,000 shares. Maximum permitted 25%. So 25% of the share outstanding. So 1,35,000 shares multiply by 25%. So that's come 33,750 shares. So as per these condition, as per point next share outstanding test, the maximum number of shares that we can do buyback is 33,750. Here it is 40,312. Here it is okay. So as per first condition 40,312. As per second 33,750. How much we want to do buyback? We want to do buyback 25,000 only. So there is no violation of first test. There is no violation of second test. It was 25,000 lower than this and lower than this. Okay. Now third is debt equity ratio test. Third, debt equity ratio test. Okay. Debt equity ratio test. After buyback, debt cannot be in excess of twice of paid up capital and free reserves. Paid up capital and free reserve. So what is the second condition? After the buyback, your debt cannot be more than the twice of the paid up capital and free reserve. So first, how much is the debt we have? So first is debt. We are making working note on debt, working note number 2. So you can take a total from there. How much it is? It is 48,25,000. 48,25,000. So here 48,25,000. 48,25,000 is the existing debt. Now how much we can do after the buyback? Write down there. Minimum paid up capital and free reserve. Minimum paid up capital and free reserve to be maintained after buyback. How much is to be minimum paid up capital and free reserve that should be maintained after buyback? That is 50% of debt. So write down here 48,25,000. 50% of this it should be maintained. So 48,25,000 multiplied by 50%. That's come 24,12,500. This much should be maintained. Paid up capital and free reserve after buyback. Minimum it should be maintained. Why? Suppose if it is lower than, just for the understanding purpose, take a lower of this 24. If I say this, suppose it is 24 lakh. Your paid up capital and free reserve after buyback, suppose it is 24 lakh. And twice of 24 lakh will come 48 lakh. So your debt will be more than 40. Debt is more than 48 lakh. This is 48 lakh 25. So your paid up capital and free reserve should be at least 50% of your debt. So after buyback, your paid up capital and free reserve, it should be how much? 50% of your debt. Okay. So write down here how the present, point number C. Paid up capital, here I write present, like present paid up capital, and free reserve that we have calculated in working note number 1. How much is paid up capital and free reserve? 32,25,000. So existing is 32,25,000. How much existing is 32,25,000? Remember one. Now, how much paid up capital exists? Sorry. How much paid up capital and free reserve existing you have? So existing paid up capital and free reserve is 32 lakh, and whenever I use any color other than blue color, that is for your understanding. So you don't have to write it down in examination, this box and all. This is for your understanding. Okay. So existing paid up capital is 32 lakh 25,000 paid up capital and free reserve. Okay, this is existing, present paid up capital and free reserve. Okay. Now what happened? Out of this 32,25,000, some will be transferred to CRR. To CRR, I call it X. And some should be maintained. Minimum it should be maintained. How much it should be maintained? 24,12,500. And remaining I can utilize for the purpose of buyback. It means this 32,25,000 is present paid up capital and free reserve. Some should be maintained in the form of CR. Out of, from 32,25,000, some amount will be maintained in the form of CR, and some maintained as a part of paid up capital and free reserve. It should be maintained, and remaining can be utilized for the purpose of buyback. So we have to solve equation for it. So what we can do here, keep this, you have the space here for at least there should be space for 8-10 lines here. Okay, because we will write one note also here. So you have to prepare write down your note, working note number 1, working note number 2. Now below working note number 2, write down. Below working note number 2, write down working note number 3 now. Amount, write down there. Amount transferred to CRR and maximum equity to be bought back will be calculated by simultaneous equation. Okay, write down here. Suppose amount transferred to CRR is X and maximum permitted buyback is Y. Okay, so write down here then first equation is I have 32,25,000 is the present paid up capital and free reserve. Some amount will be transferred to CRR and some should be maintained, that is 24,12,500. So remaining is the what amount of that amount that we can utilize for the purpose of buyback. Second equation, if I say Y, what is this Y? The amount which is available for the purpose of buyback is Y divided by, if I say divided by 20 is how much? 20 is the buyback price. So total amount available divided by amount of we are paying amount per share. The total amount available for buyback and the amount we are paying for one share. So Y divided by 20, then the number of shares we are doing buyback, that will come Y divided by 20. And if I multiply by 10, that is face value. We have already discussed in previous question this. Multiply by 10, that is face value. So what we transfer to CRR? We transfer to CRR face value of shares buyback. This is the total amount of buyback divided by amount we are paying on buyback. The number of shares for buyback come. Now multiply by face value, then the amount of CRR will come. What we call it? We call it X. Or can I say it 2x equals to Y. 2x equals to Y. Okay. So here by solving the above equation, we get, what we get? X equals to Y. We have to calculate. So here write down Y equals to, this is 2x, not 2x it is. So 2x, so here x will come here, it will come 3x. So 33,25,000 minus 24,12,500 divided by 3. This one 32,25,000. Okay, 32,25,000 minus 24,12,500 divided by 3. It is coming 2,70,000. 2,70,000. Okay, 2,70,000. 833.33 is coming. So 2,70,833.33 is coming. But do you think that 2,70,833, let's take 833, but how much is the face value? Face value is rupees 10. So we cannot say 2,70,833. Why? Because the face value is 10 now. So here we will write 2,70,830. Now I will say why 30? So if I say 2,70,800, if I take 2,70,833, just take suppose right. Type in your calc 2,70,833 divided by, if I do 10, so it will come 27,083.3 share. So can we issue the shares in fraction? No, we cannot issue. So that's why I take 2,70,830. Don't take 833.3. Don't take 833.33. Take 830. So here now we have found it X, so 32,25,000 minus 2,70,830 minus 24,12,500. It's come 5,41,670. 5,41,670. Okay, so we have found it X and Y. Write down there. Write down here. All of you have written this X and Y. X is the amount of CRR, Y is the amount of buyback. So write down here now. We have written here point number C. Now below this point number C, write down point number D. So point number D is maximum permitted buyback of equity we have calculated in working note number 3. How much is the amount? This 5,41,670. Point number E, maximum number of shares that can be bought back at a rate of rupees 20 per share. So here it will come 5,41,670 divided by, for one share you are paying 20. So divided by 20, that's come 27,083.5. So write down here 27,083.5. So we will take only 83. Okay. 83. Okay, 83. 27,083 shares. So as per this debt equity ratio, maximum number of shares that we can do buyback is how much? 27,083 shares. So 27,083 multiplied by 10, that will come how much? Amount of X, 2,70,830. Okay. Now here we will write a note here. So the maximum number of shares that we can do buyback is the lowest of these three tests. So and lowest of these three is, I think it is 27. This is the lowest of these three. 27,083. How much we want to do buyback? We want to do buyback 25,000, which is lower than 27,083. So there is no violation of Companies Act here. So write down maximum number of shares. Maximum number of shares that can be bought back. Write down in bracket least of the above three. The least of the above three. There is 27,083 shares. 27,083 shares. Company qualifies all tests for buyback of shares. and conclusion is that it can buy maximum 27,083 shares on 1st of April 2016. But how much they want to do? 25,000 only. However, company wants to buy back only 25,000 shares at a rate of rupees 20. Therefore, buyback of 25,000 shares as desired by the company is within the provision of the Companies Act within the provision of the Companies Act 2013. Okay, now they are not issuing any share in the market, it is out of profit. Now we have to pass journal entry and then we have to prepare balance sheet. Okay, Okay, now after working note number 3, write down there journal entries in the books of Complicated Limited. Journal entries in the books of Complicated Limited. Okay. Now draw this for half page. Only 4 entry will come. Okay. Okay. Now first entry on 2016 April 1st. First we have purchase shares from the market. So what entry we pass for it? Equity share buyback account debit to bank account. Equity share buyback account debit. We are doing buyback of 25,000 shares. And for 1 share we are paying how much? For 1 share we are paying 20 rupees. So 25,000 shares, for 1 share we are paying 20 rupees. So 25,000 multiplied by 20, that's come 5 lakh. So equity share buyback account debit to bank account 5 lakhs. Being buyback of 25,000 equity shares of rupees 10 each at the rate of rupees 20 per share. Okay. Now second point, we have purchased share. Now we have to cancel it. When we cancel it, decrease in capital. What we do? Decrease in capital, debit it. So equity share capital account debit. Equity share capital account debit. So we are doing buyback of 25,000 shares, and for 1 share face value. Always remember, when you cancel capital always recorded at face value. When it will cancel, it will be cancelled at face value only. So equity share capital account debit 2,50,000, 25,000 shares multiplied by 10. Now we are paying extra 10 rupees. Shares of rupees 10, we are paying 20. The additional 10 we are paying, that is premium on buyback with expenses. Premium on buyback account debit 25,000 share multiply by rupees 10, that's come 2,50,000. 2. Now we will cancel. We have purchased this share, now we are cancelling this share. To equity share buyback account. To equity share buyback account, that is 5 lakh. So being cancellation of shares buyback, being cancellation of shares buyback. Now we have paid some premium on buyback, so we have to write it off. So how much we want to write it off? 2,50,000. This amount, that's premium on buyback. You know that premium on buyback, it can be adjusted against securities premium, it can be adjusted against profit and loss account, or it can be adjusted against general reserve. So we will adjust against suppose securities premium. So whether we have balance of 2,50,000 securities premium, so you see here we have balance of rupees how much? We have 2,50,000. So we will adjust against securities premium. We have 2,50,000. So write down here securities premium account debit. Securities premium account debit. Securities premium account debit 2,50,000 to premium on buyback account 2,50,000. Okay, so here you have debited this premium on buyback and then you have credited it. So you have cancelled this premium buyback against securities premium. So write down here being premium on buyback, being premium on buyback adjusted against securities premium account. Securities premium account. The first entry we have passed for equity share buyback. First we have purchased, then we have cancelled the share, and then we have adjusted the premium on buyback. Now it is not out of fresh issue of shares, it is out of profit. So we have to transfer to which account? CRR account. So you can see here, then we have to transfer to CRR account. What entry we pass here? So we can utilize general reserve, profit and loss account. We can also utilize securities premium, but don't give priority to security premium when we transfer to CRR account. Because what I have observed, then institute transfer to CRR account at the time of buyback of shares out of profit, generally they don't utilize securities premium here. So first preference give to general reserve, then profit and loss account. If you don't have balance, then only utilize securities premium. So here, how much we have transferred to CRR account? We have to transfer the face value of buyback. The face value of buyback is 2,50,000. Write on fourth entry now. Write on fourth entry here. Write on fourth entry here. So here fourth entry, whether we have some balance in revenue reserve or something, just give me a minute. Yes, we have in revenue reserve, we have enough balance, we have 15 lakh. So here, write down revenue reserve account debit, revenue reserve account debit, revenue reserve account debit 2,50,000. Why 2,50,000? The face value of buyback of shares is 2,50,000. So we have to transfer only face value. So revenue reserve account debit 2,50,000 to capital redemption reserve account 2,50,000 being face value of shares bought back out of profit, transferred to CRR account as per law. Transferred to CRR account as per law. Okay. Now you have passed journal entry. Now we have to prepare balance sheet. Here. Okay. So here this equity share buyback account also get cancelled. You have debited here equity share buyback account, and then you have credited here equity share buyback account. That also cancelled. Okay. Now we have to prepare balance sheet. So write down here balance sheet. Balance sheet of Complicated Limited after buyback as on 1st of April 2016. Draw this a little bit more than half page. Okay, little bit more than half page. Okay. Okay, write down there. Note amount. Okay, note amount. So here, first equity and liability. Equity and liabilities. Equity and liabilities. Point number 1. Shareholders fund. Under shareholders fund, share capital will come. Then reserve and surplus. Okay. Now, second point, non-current liability. Under non-current liability, a long-term borrowing will come. Then current liability, third point, current liability. Okay, current liability. Under current liability, write down short-term borrowing. Just write down, I will explain each and every point. Short-term borrowings, then other current liability. Other current liabilities. Okay, other current liabilities. So now here the total will come. Then assets. Here assets. Okay, write down there non-current asset. Non-current asset. Property, plant and equipment. Property, plant and equipment. Property, plant and equipment. Intangibles. And then non-current investment. Non-current investment. And then write down second point here, current asset. Okay, the bifurcation is not given here in current asset. Just write down current asset. Okay. Okay. So we'll prepare a notes to account on share capital, reserve and surplus, long-term borrowing. As the short-term borrowing, there is the one new item that we are going to discuss here, that is current maturity of long-term borrowing. So write down here, notes to account number 4, and write down also these other current liabilities. Okay, other countries. Just write down. I will explain it. Don't worry. So note 1, 2, 3, 4, 5. There is no need to prepare a notes to account on property, plant and equipment, because only the one item is given here. This is where is property, fixed asset. They have used the word fixed asset. Now as per the schedule 3, as per the account standard 10 also, we use the word property, plant and equipment. That's why I've written a property, plant and equipment. Okay. So one by one. So where this share capital will come? Share capital is how many? 12 lakh 50 plus 1 lakh. So write down there 13 lakh 50,000. So how much? 13 lakh 50,000. So 13 lakh 50,000. Okay. 13 lakh 50,000 total of these two. What you have done here, you have here, when you have passed general entry, so you have here, you have where is share capital? You have cancelled share capital by rupees 2 lakh 50,000. So 13 lakh 50, you have debited here. So we have to deduct it. You know that capital liability is credit balance. If you debit it, minus. If you have credit, add. So if debited here, so minus 2 lakh 50,000. How much it is? It's come 1 lakh 10,000. How much it is? 1 lakh 10,000. So write down there in notes to account number 1. Notes to account. Notes to accounts number 1. Share capital. Share capital. This 11 lakh it is. It is 11 lakh. Okay. And share of rupees 10 each. No? Share 11 is the amount of capital. And one share is of rupees 10. So we can say how many number of shares? 1 lakh 10,000. So 1 lakh 10,000 equity shares of rupees 10 each. So here it will come 11 lakh. So total amount of share capital is how much? 11 lakh. You can write it down. You can write it down in balance sheet 11 lakh. Okay. So write down in balance sheet 11 lakh. 11 lakh rupees. Okay. Now after this, second item is share option outstanding account. That is a part of reserve and surplus. So make working notes account number 2, reserve and surplus. Reserve and surplus. Share option outstanding account. Share option outstanding account. Share option outstanding account. How much it is? Share option outstanding account is 4 lakh. 4 lakh. Okay. Now second is what? Revenue reserve. Revenue reserve is how much? 15 lakh. Revenue reserve, write down in inner column 15 lakhs. So whether we have utilized revenue reserve? Yes. Here you can see we have debited his revenue reserve. So how much I have written? By mistake I have written one more 0. It is 2 lakh 50. 30. 1, 2, 3. Okay. 2 lakh 50,000. So we have debited. Revenue reserve as credit balance. We have debited, we will deduct it. So write down here, less transfer to CRR 2 lakh 50,000. So how much will come in outer column? 15 lakhs minus 2 lakh 50,000. It will come 1 lakh, sorry, not 1 lakh, 12 lakh 50,000. 12 lakh 50,000. 12 lakh 50,000. Okay. Then after this we have securities premium 2 lakh 50. But securities premium we have utilized here. We have utilized the securities premium. We have debited here 2 lakh 50. So in outer column 0 will come. So write down there securities premium. Securities premium. How much we have here? 2 lakh 50,000 less adjusted against premium on buyback. Premium on buyback. How much it is? 2 lakh 50,000. So in outer column 0 will come. Okay. In outer column 0 will come. Next item now. Next item here is profit and loss account, which is 1,25,000. So write down here. Next item is profit and loss account. Whether we have utilized profit and loss account? No. So one more important thing, you have transferred it to CRR. So we have to write down CRR also, because new account CRR has been created here. So first write down profit and loss account. Profit and loss account. How much balance we have in profit and loss account given in question? 1,25,000. Okay. 1,25,000. Then we have capital reserve 1 lakh, revaluation reserve 1 lakh. Write down there. Capital reserve. Capital reserve 1 lakh. Then we have revaluation. Revaluation reserve. We have 1 lakh. Revaluation reserve we have 1 lakh. And here we have created this capital redemption reserve account by rupees 2,50,000. So write down here. Capital redemption. Capital redemption reserve account. How much it is? Capital redemption reserve we have transferred to CRR account 2,50,000. Now do the total of this reserve and surplus. 4 lakh plus 12,50,000 plus 1,25,000 plus 1 lakh plus 1 lakh plus 2,50,000 is 22,25,000. 22,25,000. So write down this 22,25,000. Write down this 22,25,000. Where it will come? In balance sheet under reserve and surplus. So write down here 22,25,000. Okay. Now in balance sheet, next is unpaid dividend. Remember, unpaid dividend, we know that it's a debt, but it's a short-term debt. You can see it is a current liability. It is a current liability. Okay, it's a current liability. So and debenture here, it's a debenture here, it's a long-term borrowing. It's a long-term borrowing. Okay, it's a non-current liability. It's a non-current liability. Advances from a related party. Okay, write down one by one. Just write down one by one. Write down here notes to account number 3. Write down here notes to account number 3. Short-term borrowing. Short-term borrowings. Sorry, notes to account number 3 we have prepared on long-term borrowing. I'm sorry. Write down there long-term borrowing. Long-term borrowings. Keep this space for 3-4 lines and then write down short-term borrowing. Short-term borrowings. Okay. Then keep this space for 2-3 lines and then write down note number, write down here 5th, which is other current liabilities. Other current liabilities. Other current liabilities. Now one by one. We can see that the first item is unpaid dividend, which is other current liability. It's a current liability, come under the heading other current liability, that is 1 lakh. So write down here unpaid dividend, which is 1 lakh rupees. 1 lakh rupees. So write down there unpaid dividend, which is 1 lakh rupees. Next item now. Here you have 12% debenture secured. It's a non-current liability. Remember, it's come under non-current liability, and under non-current liability, it's come under long-term borrowing. You can see here in balance sheet, you can see non-current liability, and under non-current liability, it's a long-term borrowing. So write down in notes to account number 3, secured. It is a secured loan. So write down the secured 12% debentures. 12% debenture. 18,75,000. 18,75,000. 12% debentures. How much it is 12% debenture? 18,75,000. Okay. Now advance from related party unsecured. It's an unsecured loan. It's a debt. We know that. But whether it's a short term or long term, so we don't know. Advance may be from the related party, it may be for long term, it may be for short term. It is not mentioned here. So we will assume that it's a long term. If someone assumes that it's a short term, then they can consider it other current liability. But if you're assuming that, if they assume a short term loan, they will write it on the short term borrowing. Okay, these both short term borrowing and other current liability both come under the category of current liabilities. Okay, and it's a non-current liability. So if we consider that advance from related party as a short term borrowing, if you assuming, not mentioned there, so I will write it down here short term borrowing. If you are assuming it's a long term borrowing, then we will write it down under long term borrowing. Long term borrowing which we are liable to pay after 1 year. That is long term borrowing. Okay. So we have to assume something, but there is no effect on balance sheet. I mean to say the total will be same of the balance sheet, obviously. But here, instead of, if you assume that it's a long term borrowing, write down here. If you are assuming it's short term, write down here. We will write a note there. So I am assuming here it's a long term. So write down there unsecured advance from related parties. You write down in bracket, assume long term borrowing. Assume long term borrowings. How much it is? It is 10 lakh rupees. So write down here 10 lakh rupees. How much it is? 10 lakh rupees. Now after this, next item is current maturity of long term borrowing. What does it mean, current maturity of long term? It's a long term borrowing, but that amount which is payable within here, we have discussed here. Any liability, it may be long, it is a long term borrowing in fact. But the amount which is payable, suppose the loan is 1 crore, and within 1 year we are liable to pay suppose 10 crore. Sorry, 1 crore. Suppose the loan offer is suppose 1 crore, and within 1 year we are liable to pay suppose 10 lakh. The 10 lakh is the current maturity of long term borrowing. So it will not be reflected as per Schedule 3 under the Companies Act. It will not be reflected under long term borrowing. If it is the current maturity of long term borrowing, it means we are liable to pay within a year. That will be reflected under short term borrowing. So write down here current maturity of long term borrowing, borrowings, 16 lakh 50,000. Current maturity of long term borrowing, how much it is? Current maturity of long term borrowing, how much it is? 16 lakh 50,000. Okay. Now here after this, application money that we have received is excess application money that we have received of rupees 2 lakh. Then we are liable to refund it. It's a under current liability, short term borrowing and other current liability. It will come other current liability. So write down here application money received for allotment due for refund. How much it is? 2 lakh rupees. How much it is? 2 lakh rupees. So total amount here 1 plus 2, how much it is? Total amount here is 3 lakh rupees. How much is the total amount? Total amount is 3 lakh. Okay. Any item pending? No. Yes, sorry. Fixed asset. Now you can do the total of these 3 notes to account, 3rd, 4th and 5th. So here it will come 28 lakh 75,000, 16 lakh 50,000. So 28 lakh 75,000, 16 lakh 50,000 and 3 lakh. Now write down all these 3 in balance sheet. 28 lakh 75,000, then 16 lakh 50,000 short term borrowing, other current liability is 3 lakh. So other current liability is 3 lakh. Okay. Now there is no intangible asset, there is no non-current investment here. How much is the property, plant and equipment which is given in question? Which is 46 lakh 50,000. So write down here 46 lakh 50,000. Write down here property, plant and equipment 46 lakh 50,000. Okay. Now after this, Next is current asset. You know that bank account is also a part of current asset. So 40 lakh, okay, type in your calci 40 lakh. If you observe, we are in general entry here. In general entries here, we have credited bank account by rupees 5 lakhs. So minus 5 lakhs. So how much it will come? 35 lakhs. So write down here. Current asset, you can write down in bracket. Total amount which is given 40 lakhs minus 5 lakh that you have paid. In outer column, it will come 35 lakh. Now, if you do the total of balance sheet now, 11 lakhs, 22 lakh 25,000, 28 lakh 75,000, 16 lakh 50,000 and 3 lakh. How much it is? 81 lakh 50,000. 46 lakh 50 plus 35 lakh, it is 81 lakh 50,000. Okay, done. 81 lakh 50,000. Now here in the general entry that you have passed, you can see there you have debited here this equity share buyback account and then you have credited it. It gets cancelled. The premium on buyback you have debited here by 2,50,000 and you have credited here cancelled. So all points we have considered yes. Okay. So here this is question number 5th. We have done with question number 5th. Now we will take a break for 10 minutes and then we will come to question number 6. But before I start question number 6, there is a concept called redemption of preference share that I will discuss with you. Then we will solve question number 6 after the break. The break for 10 minutes. Those who are watching here on Google Drive, so just take a break for 10 minutes only. No, don't take more than 10 minutes. Okay, take a break for 10 minutes only, so that within the time frame your class will also be completed. If the lecture is for about 2.5 hours total, part 1 and part 2, and you're taking a break for half an hour in between, the lecture will go to 3 hours. Don't do that. Take a break for just 10 minutes only. Okay.